It is unusual for a half a day of trading, usually stuck in the middle of a long uh, weekend. They have to open it for a half a day, the markets for a half a day, because legally they cannot have the markets closed for 4 days in a row. But as we can see, what happened on what day was it? Monday, the Dow still had a very strong day, and inordinately strong, up about 130 points. But up until that point, we can see there was really no trajectory that could be identified. Now we can start seeing this little slow curve. And the important factor is the markets are continuing to trade, or the Dow is continuing to trade above the T line. This just puts the probabilities that the uptrend is in progress as long as there's a close above the T line. And another confirming factor is the transportation index. It's already done the little J-hook type pattern and moving it into the next wave, indicating there's going to be more upside. But the NASDAQ is trading below the T-line, still heading down. So when you take all those that assessment of the indexes into account, it basically boils down to that the overall market trend hasn't changed. There's just specific sectors that are selling off while other sectors are being bought. So a major advantage of candlestick analysis is it can quickly and easily identify which sectors are starting to be short candidates while other sectors are still being held long. So it doesn't take a very sophisticated technical analyst to figure out that our recommendation on short positions like IPHI, you stay short as long as it stays below the T line. The additional confirmation is, notice the big bearish engulfing signal that failed right at the 50-day moving average, which the 50-day moving average has been acting as a resistance level, and they're starting to sell it off again on confirmation of that signal and staying below the T line, with the prospects that it's heading lower because the downtrend is heading lower and we haven't seen any buy signals. And the use of the T line allows you to stay in long positions that, even though they get a little bit dicey, as long as they don't close below the T line, you know your uptrend is still in progress. And the use of the T line helps us identify different patterns. This is a bobble pattern. Failing at a resistance level, bobbling back to the T line, coming back up through. We can repurchase if we took profits in here, knowing that as long as it stays above the T line, we stay long. And where was the next likely target? Up at the 200-day moving average. Utilizing candlestick signals and patterns helps an investor much more accurately assess what the trend is doing, where their support and resistance levels are, when to get into a position, when to hold a position, and when to close out that position. That'll be it. We'll see you in the chat rooms.